Hello, everybody. Welcome to another Goldfields macro meeting. Today is the February 23rd to 2026. We have a lot of stuff to talk about. So let's begin. This week last week we had the news that Supreme Court striking down tariffs, but left refund issues unsettled. We believe that the Trump administration is likely to reconstitute many of these tariffs using other legal authorities. So the tariff fighting is not over. All this back and forth will probably be bad for risk assets because markets, as we may know, the markets don't like uncertainty. Okay. We also observed last week the FOMC funk minutes turned more hawkish. Underlying growth trends remain stable even as headline GDP decelerated last quarter. All the real-time data GDP forecasters like the Atlanta Fed or maybe the New York staff, they had bigger expectations. But I think that their high data frequency does not include things related to government shutdown. What seemed to impact the number one or 1.5 points lower was the government shutdown. So it disappointed on the downside, but it seems that the dollar sold off a little bit, but markets didn't pay much attention to that. On our highlights now, we are including Japan because a lot of stuff going on in Japan now. They are enacting some disinflation policy driven, reducing gasoline prices, reducing tuition fees for high schools. Also on the Kobe letter, we read that there are some unrealized losses on domestic bond holdings for Japan's fourth largest life insurers, which reached a record $86 billion in losses. Okay, it's already been talked about using some lax accountability practice or at least expand these losses throughout time for these insurers. They are major players and major companies in Japan, so this could cause some noise and some trouble. We'll see what happens. And in Brazil, we still have strong financial inflows. First week of February was weak, but the second was also strong once again, and we'll talk about that later on. Okay. So still have the three base cases. Market is tilted more on the upside than base case scenarios, where Fed still cutting rates with inflation unchecked. Number two, economic weakness, and Fed continues to rate cuts. Number three, which according to JP Morgan would be Fed cutting despite inflation picking up and the Fed credibility in question. We have all these three probable scenarios, but probability, looking at prices, we can see the probability is more on number one and number two, and number three will be very bearish for risk assets. Okay, I personally would give a 40, perhaps 20 here. I have to think about it. According to cross-border cap, which we like the liquidity analysis very much. Latest liquidity data point to some stability. However, there was some rise view, which we can view as temporary. It was largely the result of Fed RMP, Reserve Management Purchase, and also the jump in PBOC liquidity injections ahead of the lunar year. Same thing the Fed did before Christmas, adding liquidity to the market. Chinese central bank did for the lunar year, okay, for a big holiday. The absolute level of global liquidity is inching higher, but this upward momentum has been broken. Well, we can see that by looking at Bitcoin and crypto prices. What we know now is that crypto prices have been more related to dollar liquidity, and gold and silver more related to PBOC and Chinese liquidity. Whenever you can see that PBOC added liquidity, gold prices spiked, still going up today, and crypto, on the other hand, is going lower. Okay. Well, Chinese have restrictions to invest in cryptos anyway. Well, regarding liquidity, we know that nowadays 2/3 of capital committed to financial markets are more related to rollovers of existing debt instead of financing new projects and entrepreneurs. So debt rollovers have been a major issue and will be for a while. And we are reaching in 26, 27, throughout 2030, a so-called debt maturity wall. So far, flows have been very balanced. Fixed income funds are receiving money, and government debt is expiring and being rolled over. Markets are functioning, but this situation here, this big debt maturity wall, puts us into, how can I say, walking on thin ice. Okay, because anything goes wrong here, central banks will probably have to come back to injecting liquidity, creating money, etc. Because size and scope of these rollovers are very big, are huge. So far so good, but we have to keep an eye on it. Okay. Repo, slightly stressed once again. This is credit. This is the private against government credit on major money market funds, dollars. So whenever this graphic spikes up, it means that there are some stress for funding. You have to keep an eye here too, because they had controlled it and now it's moving slightly higher. And regarding global liquidity, we have the canary in the coal mine, which is BTC for dollar liquidity, we can say. And BTC has been grinding lower, probably following the loss of momentum on dollar liquidity. Okay. The reverse repo, it's been put to work, all this money in money markets and risk, probably. So the cushion is smaller. Bank reserves, the big discussion, whether we will have to keep them at these levels, or if the Fed ever wanted to reduce its holdings, how would it be feasible? Would we reverse the 2008 legislation that enabled the Fed to buy long-term assets? We would have to increase room for leverage in private banks, so they could transfer the risk from public to private banks once again, which is the opposite of what happened in 2008, when private risk was transferred to public entities. Okay. So, well, the bottom line is, if this goes much lower, we'll probably see some stress in the markets again. Okay. M2 money supply has been growing steady at 4%, nothing much to see here. That's one of the reasons why inflation is being kept in place. So total bank credit, last number was a good number. Not sure if it's just a blip or if it's a change of trend, but it is helping the real economy to grow. It's growing more than nominal GDP now. And we also highlighted gold adjusted by M2 money supply, which is the one that the Federal Reserve publishes, is now reaching 2011 highs. And if we were to repeat what happened in the 1980s, we could see this double in value and go to $10,000. Okay, that would be the equivalent to this point here. But this point is equivalent of the 1900 that the precious metal reached in 2011, the last commodity peak that we had. Okay. Regarding dollar levels, last week with tariffs being suspended, the dollar weakened a little bit because the market viewed this as an opportunity to say, okay, if you don't give me tariffs, I will compensate that by weakening the dollar even more. So the dollar lost some ground last week on that rationale. I still view 100 on the DXY, which is far more than 3% away now. I think that is the threshold that would trigger stress in the markets. It could reverse some of the ongoing trends. Okay, but so far it is not going that direction. Market still prices for next meeting. No changes in Fed funds. We had a more hawkish FOMC minutes last week. For the end of the year, we can see that the probabilities, they lost some grounds on the extremes, on the rate reductions extremes, probably because of the 5 minutes. So here they are where they are now. So this side of the equation did not change much. 2 quarters cut, 1 quarter, no cuts, but this area reduced a bit, which should be bullish for dollar. But I still think that if the market ever realizes that there will be no more cuts or even just one, something like that, then the dollar will move. But so far, it is not going anywhere. The Atlanta Fed updated their GDP now for growth forecast, 3.1, still very strong. And the New York Fed GDP nowcast is now 2.5%. Still strong numbers for the economy the size of the US, okay? The market is watching closely CapEx spending for big tech names. How is it going to be funded? If everything is still in place, etc., etc. Remembering that if you sum up all their CapEx, we're talking about 2% of GDP now, which is a huge number. Well, the online graphic did not work here, but personal income still going up. Nothing to see here. We had an update on leading economic indicators. They declined once again. Interesting to see here is that stock indexes and credit still give a positive balance, but consumer expectations and new orders are contributing to a negative reading. But still, we are far away from, not far away, but we're still out of recession levels for the last 6 months. And well, anyway, we have to keep an eye because coincident numbers are still climbing and leading are still grinding lower. So there's a big discrepancy here. We'll see which one prevails, all right? On the inflation front, everything seems to be very calm, both in implied and current inflation. The nowcasting from Cleveland Fed is predicting reduction. CPI for February almost at the target. PCE is slightly higher, still sticky. The PCE is a much broader measure of prices in the economy. It accounts prices paid by the government, etc., etc. Whether the CPI is more of a consumer basket, trying to replicate a consumer basket, okay? So that's the reason why the Fed uses PCE. PCE is much closer to a GDP deflator. The break-even inflation, well, the graphic is not here, but it is still well behaved, close to the target, 228. Last week was 227, so not much here, still positive, contributing to risk assets. The 10-year after reaching these recent highs of 430, that technically speaking, it felt the resistance here, failed the resistance. Now we are approaching the 4% levels once again. For tips, one of the assets that we like for allocation, trading at 179, we like to invest if it goes closer to 2%. It's one of the attractive assets to have. Credit spreads narrowed last week a little bit, still very, very narrow, historically speaking. So this is still a green line, a positive contributor. The junk ETF also is still above its average. It threatened to go lower, but it recovered and still giving positive risk on signals here. And this week I had took this calendar from JP Morgan. Thank you, JP Morgan, for the contribution. Today we don't have much numbers. Tomorrow we have some housing numbers. We have some big auctions, 2-year notes. On Wednesday we have 2-year floating rate notes, 2-year note again, 5-year note. If you sum up all of it, it's like $200 billion. It's a lot. And then 45 billion on 7-year note on Thursday. In February, you'll see the PPI and construction spending numbers, okay? Talking about equities, this is an interesting graph. I think it's also from JP Morgan, but we can see here that the erosion of premium from the software companies, their risk premium increased a lot, and market is now favoring hard assets, commodities. And for two big names, Microsoft used to trade at north of 30 times earnings, is now trading at 23. And Exxon, on the other hand, now that commodities are more on the news, especially big investors' appetite now, you can see that their P went all the way from the single digits to 20 plus, and they converge. This hasn't happened for a long while, and this is very interesting to see. Well, we have the hard asset stock, dollar devaluation, everything all people know. We hear about this all the time. And Microsoft is that the market is now on the mode that AI will disrupt software makers. Software makers will have a hard time keeping pace with competitors, with AI helping developers build new software. So it's very early to tell, but that's what is priced in. Okay, you can either agree or disagree. JP Morgan has compiled some numbers on companies reported. 75% have reported beat earnings per share estimates. Their growth is 12% year on year. So it's a big number. They are realizing a good 12% growth, which is a lot for a market cap size of the US market. And some sectors are printing double-digit earnings per share growth. Healthcare is lagging, and revenue is growing at 9% per year, ahead of 2% projection. Okay, I also included Japan here, since Japan is now in the spotlight. The equities went ballistic last year and this year, but they have 0% earnings per share growth so far, and revenues is only 4%. Okay, so here we can see the sectors. Earnings per share growth 12% total. We have highlights for financials. This is impacting our markets here too. IT, communication services, real estate only 3%. So cyclicals are moving faster than defensives. And we can see healthcare on the negative side, 0%. Materials and industrials are also above the average, okay? So this is helping commodity-related markets like Brazil. NVIDIA, here we have their graphics. NVIDIA has been sideways for a while, still on, above their average. The market doesn't seem to be caring much about this, but any negative news, because of its weight on the indexes, we can see some noise, okay? But so far, it's okay. MSTR, on the other hand, has been suffering a lot as it is a leverage bet on Bitcoin. Today, we can see that it is falling along with the cryptos. And we are entering March, which seems to be a positive month on average, but this is just historical average, nothing guaranteed here. And the S&P is also nearing its averages. It was threatening to break last week when tariffs were reverted. Market viewed it as positive, but today we can see that the indexes are falling again. So if we break these averages, we may see lower levels, okay, fast. The S&P denominated in gold is very oversold because gold has been climbing steadily. This is one of the few bullish relative graphics for U.S. equities against bonds. Last week, equities recovered a little bit, trying to break through these averages here, but this has been a long ride of favoring equities in spite of bonds, okay? You could see a sharp reversal if there's a big sell-off. YWM, the Russell 2000 ETF, still bid. The bank index, big bank index, still above the average. Last week we saw some companies on the financial sector losing a lot of value. Talks of AI disruption for insurance brokers and companies that rely on heavy human workforce. Still think it's too early to tell, but anyway, the market is the market, okay? Regional banks are still bid above their averages. Home builders, even though we saw on the earnings, real estate's not doing very well, but here this is definitely a bullish chart, so spells good things for the real economy. Finally, Walmart, a big important retailer, it was trading at all-time highs after the reported results, and then sold off a little bit on profit taking. We'll see what happens, but still this looks like a bullish trend, and the overall economy may be doing well, okay? VIX trading 20 plus. We would be starting to look at possible buys of equities if it breaks 30. Doesn't look very probable now, but without this back and forth with tariffs and the president and Congress, etc., it can happen. So we just wait and see. Last week we commented on how implied correlation, realized correlation was, and implied correlation index is still trading at low historical levels, 14%. If you look at the history, it is around here. It's a low level, which inspires some caution on our side, because this means that market may be short gamma on index options, and if they have to cover up, we can see huge swings, okay? So we have some positives, some negatives. I would be mostly neutral in US by this time. waiting for opportunities to buy on pullbacks whenever implied correlations spike and the VIX also spike, and if there isn't much prospects of inflation going up, if we have a deflationary crash, it's okay. If we have an inflationary one, we'll have to think about it. Okay, it's not straightforward. The international, well, rates have been going down in all European countries. Italy just recently had a debt upgrade by Moody's. It is trading near support here at 334. France, which we thought could break through the 3611, big stress would come. See how the market is reversed to the other side and now reaching support here at 330. The stock market is reaching new highs, remembering that France, apart from very strong food industry, they also have luxury exports to China and other countries are very strong, and those are reaching new all-time highs, okay? And now switching to Japan, this piece came from JP Morgan. The January nationwide CPI showed strong policy-driven moderation that began in December. The core is now trading at 2%, marking the second consecutive month of sharp decline. Main driver of this drop was the cut in gasoline price implemented following the formation of the Takaichi administration. Policy-driven disinflation is not limited to energy, is also affecting services via measures such as free high school tuition and restraint on medical fee increases. So according to Morgan, excluding these effects, inflation appears to be neither accelerating nor decelerating and seems anchored around 2%. So you have 2% constant inflation. If you keep overnight rates below 1%, on average, bonds trading at 2% or lower on average. Some tenors are much higher, but on average, then the government is cleaning some debt via inflation. This is also a very unstable equilibrium. So far it's working, but we know market can swing and stress very quickly on this, but we have to keep an eye here because Japan can be a source of future stress, okay? The paper losses that we spoke about a while ago, it's documented here. Bloomberg reported. It might very well be true because insurance companies are always buying government debt to have some yield on their floats, their floating money, and now they're probably accounting losses on them. The monetary base is still shrinking in Japan. Rates have come down a little bit to 10 for the 10-year. Their currency doesn't know where to go because some people say Japan is cheap, the currency is cheap, it has to strengthen, they will repatriate their holdings abroad, etc., etc., etc. Some other people say the currency has to devalue because the central bank is in a corner, because inflation has been creeping up, it's not moving much downwards from here, and they can't increase rates because of the size of the debt and also risking a recession. So we can see that reflected in the graphics. Also, the threat of intervention whenever the market goes close to 160 is spooking dollar buyers. So it will probably be sideways for a while now, okay? This, in turn, helps equities, which have been going up as of late, probably like against a hedge where you're buying real assets against possible currency debasement. And now switching to China. So Japan some positives and some negatives, okay? Switching to China, I think interesting that this compilation shows that banking sector ROE is 7.8% in China. PBOC suggests the ongoing rotation of deposits into other financial products is unlikely to trigger liquidity tightening for the banking system. And an influx of liquidity continues to provide solid support to the equities market, according to JP Morgan. This is for China, okay? So we have the 10 years trading at 180. Their currency is close to 690, still appreciating. Huge trade balance in favor of China. Their stock market has done a little pause for now, but looking at the others, we believe this will probably go in higher soon. Liquidity, the prospects for their real economy are still dire. Most of the optimism has been on tech and innovative industry, but the old industry, the old economy, not doing very well because iron ore has sold off. So did their interest rates and other commodities like steel. So Chinese has been a two fairies tale. You have to see how it develops. I still have a bullish view on China, but no, we never know when the tide is going to reverse, right? This is the euro Norwegian krona pair. Market uses to see how worried the market is on oil prices. If this pair goes much higher, means that the krona is under pressure. The market is worried about possible drop in oil prices, which doesn't seem to be the case here. The pair has been steadily going in favor of the krona against the euro. The rates going down in the UK too. Don't have much of a view here. The pound also on this 135 level for a while. Some spikes up, some spikes down around it. Same thing for German rates, close 20 bases. Their stock market also close to new highs, and the euro swinging around the 118 area. Everything here is related to dollar uncertainty. The markets just don't know what's going to happen with the dollar. This is reflected in these prices. And oil, you can see by the commentary in Japan. Well, everyone is relying on cheap oil, and I think this is where the danger lies for markets mostly. Because after all, the economy is just energy transformed, and oil is still very cheap related to other commodities. Of course, it has its idiosyncrasies, but seems that close to 60 levels, all the big sovereigns, the US and China, are buying for their strategic reserves. And if you divide oil by the gold price, you can see how sharp the sell-off has been. And remember that gold is still money, so you can sell one and use it to finance the other. So I like to look at the relatives, and the relatives tell the story of a dangerous situation here. Oil could climb a lot to do a catch-up. Is it going to happen? We don't know, but if this happens, it's probably will be the death knell on the bull market, okay, on the risk-on bull market. So oil versus silver, historically speaking, is still very low ratio. Gold is climbing once again, close to new highs, seems unstoppable. Silver, same. Copper has become a sideways market. Dr. Copper, more related to real economy. Steel, as I said, related to the real economy, is not moving anywhere. Aluminum has also realized a little bit, is also corrected a little bit. Realizes in Portuguese. It's corrected a little bit from its tops. And now we have soy prices reaching almost the short-term high. Are we going to form a double top, or are we going to break through this level? Well, this is important for the Brazilian real. One of the main items exported by Brazil is soybeans and wheat, being tried to make a 1 year new high. We have to watch wheat, because wheat, if prices go much higher, if food prices go higher, probably spikes revolts around the world. So it is dangerous. So far, it looks contained, but we have to keep an eye on it. Okay. So international, I think that oil is the main source of possible future stresses here. I would be a buyer on pullbacks. Just being careful, because it can easily go from 67, 68 to 60, but near the 60 level or below, I will be a buyer. Especially with oil-related stocks. We have been waiting for an opportunity to buy it. And now let's move to Brazil. So Brazil, for the presidential election in 2026, we'll probably keep Lula, will be on this 50% range. Flávio Bolsonaro is grinding higher by the day. We'll probably have another binary election, which will be very hard to trade on markets, because it's either a market-friendly candidate or Lula, which is not very friendly to markets, more government spending. But the thing is, when you have this 50-50 situation, there's not much to do, okay? We are probably approaching that situation, as Flávio is consolidating as the right candidate. JP Morgan Emerging Markets Money Trail, they do a very good work. It shows that LATAM is still receiving inflows, which is very good for Brazil. Emerging market equity flows on the positive side. Of course, MSCI emerging is very correlated to this. Here we have foreigners buying throughout all this period, only one negative day, and institutional local Brazilians selling for them. Personal accounts on the sidelines, financial institutions also on the sidelines. And as we said, the effects, the highlights that we had a second week of February, we have two positive inflows, one from financial segment, the other from the trade segment. That's one of the reasons that the real is so strong. And we had the best January since 2012. So it's been a good year for the Brazilian real. This has, according to BTG, this has turned 12-month cumulative flow deficit took it from the 40 billion area to only minus 17, already positive in 2026 by $6.6 billion. And now with Trump enacting an universal tariff, Brazil will be a beneficiary, because most of our tariffs are higher than that. China would also be on the list, so probably they would change it. And the UK will be the biggest loser, okay? They will have an actual increase. Well, Brazil is receiving a reduction here. So we can see all the bullishness on the Brazilian real. We are reaching this 510 psychological support. The next one is at 490 and 470, okay? Uh, from JP Morgan, we also learned that Brazilian protein exports are surging. Prices remain steady. So here is volumes for 2025. Here's the first print for 26, much higher. So it's higher beef volumes and higher export prices, because prices also printed January and February higher than last year's average. The thing here is prices are online, so we can compute it faster, and this is released by the government, so has some of delay, but both are positive. They are probably one of the engines between the real strength, because protein and beef exports are major items in our export menu. Okay, we already spoke about how the carry trade has been a killer for long reais. Regarding M2 money creation, the real behaves badly since 2020, but when we adjust that to the carry, it is not so bad. The US has a bigger area adjusted by the carry than Brazil. Brazil is going back and forth, so we have these huge swings. Now the currency is appreciating. We are almost at this level, and when we compute for the reduction and expansion, the real should indeed be appreciating instead of just expanding. On the fiscal and monetary side, not many news. We have an interesting study. We've been speaking with mostly Americans about real estate prices, how high they are in the US, and they were interested in Brazil because our prices in dollars look very low. This is the average of a apartment or house in Brazil according to FIPESAP. This is divided by the broad M4 money supply. We can see how cheap real estate is here. If we adjust also by gross workers' income, we can see that it's also reaching its lows. The graphic is like these waves because it is not seasonally adjusted, but anyway, it gives a trend, and the trend says that real estate prices can be very low, and I think it is a good risk asymmetric return to have them in a portfolio now. Okay. Implied rates climbed a little bit for Brazil 10-year, 592 for basis. It's probably caused by this little DI spike, but still, it is on sidelines, but slightly more tilted towards the downside than upside, in my opinion, because nominal GDP has been growing at 8, at the most 9%, but now it's tilting towards 7, and 15% for Selic with that background is too much. The January 27, which is a fronter end DI future, more related to monetary policy. We saw huge volume on the sell side when it moved above its average. It corrected a lot. Some DI futures are already pricing on the FRA's 1180 CDI. We'll talk about that on some of our technical papers later on, how we calculate this. And if we consider a 300 basis point reduction cycle, which I think is feasible, you can see that January 27, this level has only 28 basis points to be earned. It was 80 basis a few weeks ago. So a lot of the premium has been chopped off markets, okay? Bovespa keeps climbing to new highs. Commodities, hard assets related, very strong inflows, difficult to be against it. Some people say it's already getting expensive. I agree, but you cannot be sitting in front of a train. The most you can reduce your holdings if you already have, and maybe buy on weakness if we ever go back to these levels. The market is probably going to add on more add on strength than sell on spikes here. Another highlight is how small caps have underperformed mega caps here. We know the dynamics of foreign flows. Foreign flows typically go firstly on the mega caps, and then afterwards they go to small caps. So there may be an opportunity here to be long small caps in Brazil once we address some productivity reforms, if we have some political changes and rates can structurally go lower, we may have a bull market in small caps enacted here. So far, it's not going anywhere. It's losing big time to the mega caps. And here I have the Bovespa. I like to adjust by money supply. The last spike brought us here, almost at the 2021 highs. Remembering that this was a strong bull market both for Bovespa and small caps. And here we have only a strong market for big names, Bovespa mainly. This is the other graph zoomed in. This is a graphic of EWZ. We heard that even Druckenmiller himself was buying some EWZ and WZ calls. There's still some room for the WZ to appreciate if there's any political change against the other emergings. This is the relative. We are here. Double prices to go here. Against Mexico, Brazil is still relatively cheap. Against small caps, USA is slightly better, probably because small caps are pressured over there like they are here. Against the SPY, I don't like much this comparison because they are much different, but it is here. Brazil has recovered a lot. And here we have the government bonds against small caps in Brazil. The big spike. Government bonds have the problem of intensive supply because of nominal deficits. Here's the other graph zoomed in. And here is small cap divided by RFM, which is a fixed income portfolio replicated by Ambima. And we can see that small caps are still very cheap, risk adjusted. Well, you can see a big spike here. If Brazil ever enacts productivity and we have structural rates lower, a lot of room here for appreciation. Now we also look at corn prices, 2 positive weeks here. If this starts climbing, it's going to be some stress for beef and poultry exporters. We have to keep an eye on it. And coffee also corrected a bit for those who like to drink their morning and afternoon coffee. It's good news. So, well, that's the end of the presentation. I think that Brazil, we still have an opportunity in small caps. I would be slightly careful with Bovespa names now, big names that they seem to be slightly stretched. I wouldn't be short because of the strength of the market, but I would be adding longs mainly on small caps now, as I think that the rate cut cycle will begin soon. And I think that's it. We'll see how the political landscape develops, who is going to support who has the biggest chances. We'll keep going back and forth until October and November of this year, when we'll finally know who the next president and who will be in the Senate and the lower chamber, also very important. But Brazil still, we can see by the relatives, Brazil still has some good perspectives, okay? I hope you all have a good week. Good luck in allocating and trading. And please like and subscribe our channel if you like our analysis, okay? Thank you for all. See you on the next meeting.